Hello, thank you again for joining us, everyone. Good morning, good afternoon, and good evening to all our clients and prospects. We will now begin the webinar on the Exploration 2026, the impact of the energy transition. Next slide. So welcome back to all our clients for another Westwood webinar. As a reminder, during this live session, please submit any of your questions in the Q&A box at the right side of your screen. To our new users and prospects, today's webinar is prepared by the Wildcat team. As a brief introduction to Wildcat, the service aims to help E&P companies understand and improve exploration performance. Using Wildcat, users can monitor global E&P activity and performance, benchmark appraisal planning, and identify farming opportunities. Data analysis is pulled out from over 7,500 wells to carry out analog play statistics for success rates, discovery size distribution, and post-well failure analysis, supported by in-depth geological analysis prepared by a team of geoscientists. Next slide. Okay, so today's webinar is based on the report Exploration 2026 and the impact of energy transition that is now available to all Wildcat clients to download. To non-clients, this report is available for purchase and you can contact me at the email address at the bottom of this slide. Next. Before we begin, I would like to introduce today's speaker, Dr. Keith Myers, Westwood's President of Research. He will be joined by Graham Bagley, our Head of Global E&A, who will be facilitating today's Q&A session. My name is Illy and I am the Business Development Manager for Global E&A. It's great to see all our Wildcat clients online today, and I'd like to thank our prospects for also joining us today to listen into a heated topic that has caught the industry's attention. So over to you, Keith, and thank you. Hold on, Keith, you're on mute. Hold on, Keith. Let me unmute you. 1 second, Keith. You're still on mute. Can you go on unmute, Keith?
Yeah, okay.
Perfect. I can hear you now. Thank you.
Right. Thank you very much, Illy. Good morning, good afternoon, good evening, wherever you are. Thank you very much for joining us today. So we're going to talk about the energy transition and its impact on exploration. And I thought I would start by just sharing this press release that came out on the 3 days ago, from London, highlighting the world's first certified carbon neutral produced oil from the Edvard Grieg field. So Edvard Grieg is a field in Norway that has low associated carbon with production, 3.8 kilograms of CO2 per BOE, which actually is very low, low emissions. And they've offset those emissions by presumably, well, they call them nature-based solutions, but presumably by planting some trees somewhere to create a neutral, carbon neutral barrel. For those of you unfamiliar with the language of the energy transition, the 3.8 kilograms CO2 per BOE would be what you call scope 1 or 2 emissions. But the scope 3 emissions, when this barrel from Edvard Grieg is combusted, would be about 430 kilograms of CO2. So although Edvard Grieg is a low carbon field, it's about the average is about 5 times the Edvard Grieg carbon content per barrel. This doesn't really solve the issue because, and we'll see later that companies are having to pledge also what their targets are with regard to scope 3 emissions, as well as being carbon neutral on scope 1 and 2. But you can we all have our own opinion as to whether this is the way of the future, exploring for the Edvard Griegs of the future, or whether this is greenwash on the part of the operator. So leading into the agenda for today, what I want to do is look forward to 2026 and look at the shape of exploration and what it might look like, and what are the factors that are going to influence the exploration world in 2026. The first thing we'll talk about is the oil price, obviously, because that influences how much money that the industry is generating, how much cash it's generating, and how much is available for reinvestment in exploration. It also influences, of course, the returns that we can generate when the successful exploration comes on production. So we're not looking, it's not just the oil price in 2026. We've got to think about the oil price 10 years hence, 10 years after that, in the mid-30s, when any discoveries might come into production. We've also got to look at oil demand. We're in an energy transition to a low carbon future. The world has an aspiration to achieve net zero emissions by 2050. That obviously is going to have a negative impact on oil demand. So will there be a demand for any production from discoveries we make in 2026? Our objective, of course, in exploration is not just to make discoveries, it's to make discoveries that can be produced and meet future oil demand economically. The third thing we'll have to look at is that's going to influence exploration in 2026 is company strategy. How will companies respond to the energy transition, and how will that response in strategy play out in exploration? We'll talk about that later also. The third part is how much capital there will be allocated to exploration. That's both how much capital will be recycled from producing companies into exploration, but also the appetite of the investor community to fund exploration in specialist smaller companies, that the junior, if you like, junior end of the exploration sector. And last but not least, the geology. What geology will we be exploring? What plays will be attractive in the exploration world of 2026? What will make sense at that time? So I'm going to split the talk into three parts. We'll first of all talk about exploration drilling and the factors that will influence it. We'll go through these factors on the left. Then we'll look a bit at future exploration focus and what we might be looking at in 2026. And finally, we'll look at the competitive landscape and how it could evolve. Of course, we're looking at the future. The future is hard to predict. Some would say impossible to predict. So this is very much a discursive, rather than giving you answers to the future, is going to discuss some of the talk around the factors that are going to influence the world in 2026. And I am going to approach it very much from the perspective that the energy transition is going to happen and that changes will happen. I'm not, this is from the perspective, it's not going to be, I'm going to approach this from, this is not a business as usual future. This is that there is an energy transition that will happen. I'm going to use that as the base scenario. And then finally, if you stick around to the end, we're going to have a poll. We're going to ask a couple of questions around what the attendees think about the future and the potential level of activity and how much success there'll be. So do stick around for that and the Q&A at the end. So first of all, let's talk about the oil price. Historically, the level of exploration drilling is strongly correlated to oil price, but will that continue? If we look at the chart on the left, just showing wells and the Brent oil price since 2008, the correlation coefficient is around 0.8. It's obviously, it's quite, you know, it's not a surprise that there should be such correlation. Times a high oil price, there's a lot of free cash flow being generated by the industry that's available for reinvestment in exploration, and there's also perceived high returns from at times of higher oil price. And of course, buying assets through M&A gets more expensive, so exploration looks a more attractive option. But will this correlation hold into the future during the energy transition. And before we explore that point, it's worth saying that more drilling does not necessarily mean more success. If we impose on the chart we showed in the previous slide, success rate in grey, you'll see that as the industry cut drilling post the 2015 oil price crash, success rates actually improved on the back of smaller budgets, forcing explorers to focus on the better prospects. So a smaller, more successful exploration in the future may not be such a bad thing. So we talked a little bit about price, but what's going to control price, of course, is or have a big impact on price is future demand. So we're going to look at demand in two parts. Firstly, how much demand do we need for future exploration success? And then what is the demand outlook? What does it look like given the different scenarios, different energy transition scenarios? So the first part, I've looked at how much demand do we need for exploration success. I've done this by looking at back to 2010 and looked at how much a bigger contribution the 2010 oil discoveries are making to meeting oil demand 10 years later. So in 2010, it was actually a good year for oil discoveries. We found 9.6, just less than 10 billion barrels of oil discovered in high impact wells. This was the year of Johan Sverdrup. It was being discovered in Norway. We had Buzios in the Santos pre-salt. Of that 9.6 billion barrels, 7.8 has been developed, and it's producing 1.2 million barrels a day. So 2010 was a good year, and 10 years later, it was meeting around 1.2% of oil demand. And 81% of the oil discovered in 2010 is on production. If we look at gas in that same year, it's the exact opposite. 81% of the 30 TCF discovered that's potentially commercial is still not yet in production. Only 19% is producing 1.2 BCF a day, which is 0.3% of demand. And these pie charts, I think, explain why explorers are still very much focused on oil rather than gas, because of the challenges of commercializing a lot of the remote gas that was found in recent years. So what we're looking for, 1 million barrels of demand in a good year. If 2026 is a good year for exploration, we'd be looking for 1 million barrels a day or so of demand in 2036. If it's more like the average of the last 5 years, which is about 5 billion barrels, we might be looking at, say, 500,000 barrels a day of demand in 2036 for the discoveries that we make. So what's the demand outlook? Well, here we're in the world of forecasting demand, which is not Westwood's world. So I've taken forecasts from others to have a look at this question. The charts on the left, the blue bar is the average of what I call the 4 business as usual forecasts. This is based on, if you like, current policies which are not, frankly, on track for net zero in 2050, but where the current policies would take us. The orange bar are average of 2 forecasts, one from the IEA, one from the Equinor, for a world on track for less than 2 degrees C of warming. And the green bar is a forecast from the IEA for the oil demand in a world on a track for 1.5 degrees of warming. That is net zero by 2050. And the IEA haven't done a net zero forecast for 2040 yet, but BP did, and that's shown in the green bar for the 2040 column. What it shows is that, and I should say that the horizontal grey bar is the IEA's projection of legacy supply from legacy production assets that are already in existence, including investment in legacy assets. And there's a 36 million barrel a day gap to from legacy production to demand with no new developments in 2030. 28 million barrels a day in 2040 under the IEA and Equinor forecasts. But even if a world on track for net zero in 2050, i.e. keeping warming to 1.5 degrees, there's still a gap of 14 million barrels in 2030 and 19 million barrels in 2040. So if we're looking for 500,000 barrels a day of demand for our 2026 discoveries, or 1 million barrels a day of demand, it looks, if these forecasts are anywhere near correct, it looks like that demand will be there, provided that that our production from 2026 discoveries can compete with other alternatives to meet that demand, i.e. other other existing discoveries, or indeed US onshore unconventional production. So that I conclude from this analysis that there will be the demand there. The question is, what will the oil price be? And what exploration will make sense to deliver those barrels that will be developable and producible in the mid-30s. To my mind, $40 a barrel feels like a reasonable long-term price floor. We saw last year a demand shock that like no other, and 8 to 10 million barrels a day of demand being taken out, and the oil price averaged $42 a barrel during that year. So I think it's pretty reasonable to assume $40 as a kind of as a long-term price floor. So first thing, our exploration needs to deliver discoveries that have full cycle break-even prices less than $40 a barrel and actually make attractive returns at $40. The second point is that we don't want to make discoveries that are going to take 20 years to develop, and so discovery to production within 5 years and break even within 10 years. These are the sort of targets we're seeing companies coming out with, which do make sense in terms of cycle times. And the third thing is about emissions. So prospective developments need to meet net zero emissions targets, certainly for upstream scope 1 and scope 2, and or are viable at future carbon prices. So we would expect in the next 5 years that that carbon prices will be much more widespread than they are at the moment. They only cover a minority of production at the moment, but they'll should become more widespread if we're on track for the energy transition, and they will be at should be at a sufficiently high level to start impacting investment decisions. So developments need to be able to meet net zero emissions criteria or be viable at future high carbon prices. And the final point is that hydrocarbons with a low carbon footprint could start to attract a premium price. So this is what I call resilient exploration that will be viable during the energy transition. One point I haven't said, of course, is that we've been underinvesting in recent years, and it may well be that we do have a medium-term supply crunch and a price spike. So I'm not ignoring that, but I'm basing this on the scenario of a $40 long term if the energy transition plays out as the forecasts suggest. I'm going to turn to the future exploration focus. And sometimes it's useful when we're looking forward to look backwards to guide us. So I'm going to look at the trends since the 2014-15 oil price crash, when there has been more focus, there's been more focus on proven plays and shorter cycle times. So the pie chart showed 2010 to 14 and 2016 to 2020, and the split of spending by play maturity. I've deliberately kept out 2015 as a transition year between the two oil price regimes. What you can see is that the capital allocated to maturing and mature plays increased to 58% after the oil price crash, and frontier play allocation decreased to 20% from 28%. These trends are likely to continue given the resilient exploration criteria. It's worth mentioning that the 22% that went into was allocated to emerging plays, which is, as we know, is the sweet spot for exploration in terms of discovery size and success rate. But today's emerging plays will be maturing by 2026. And that if we're going to sustain the emerging play portfolio, it is dependent on frontier success. And frontier success is dependent on maintaining the frontier drilling program. So let's have a look at the frontier program and trends that we can see within that. Again, the pie charts are pre and post the oil price crash, and what you can see is that there's been more frontier drilling in proven basins post the oil price crash, with the hope of higher success rates. And indeed, the frontier play tests in proven basins, where there is already commercial production or a commercial discovery, are higher than success rates for frontier wells in frontier basins, but only a few percentage points, and they're still less than 10%. So we are going to have to maintain a risk appetite to maintain frontier exploration and to have and create the next generation of emerging plays. So two questions now about that and the role of the frontier. Are there more multi-billion barrel plays to be found? And we're going to be asking you that question at the end to find your opinion. And how hard will the industry search for them? You can see on the right that this is looking at the 5 largest gas plays to emerge since the pre-salt Santos in 2006, and the 5 largest oil plays. The pre-salt in Brazil is the biggest play to emerge at 30 billion barrels. But in terms of oil plays, Suriname, Guyana is the exception. Most oil plays to emerge in the last 14 years or so have been 2 billion barrels or less in scale, much smaller in scale than the gas plays that have emerged. So we've identified 60 possible frontier wells that have been identified in companies' portfolios, potentially for potential drilling in the next 2 to 3 years. 95% of those are targeting oil prospects. We expect 28 oil plays to be tested in 22. There's 28 new oil plays to be tested across 22 basins. At an 8% success rate, which is the rate we've been running at on average, 2 to 3 of these might work, and open plays that statistically are most likely to be of 2 billion barrels in scale or less. So the Frontier program is key to maintaining the emerging play portfolio, but it's unlikely to be a game changer statistically. The hurdles, I think what we can say is the hurdles for drilling in frontier basins will get higher, and therefore we would expect to see a diminishing frontier program over time. What about infrastructure-led exploration? Where does that fit in? Infrastructure-led exploration delivers high value but low volume barrels, but there is a finite supply of them. So infrastructure-led barrels do fit the resilient exploration criteria, and there has been a trend to more infrastructure-led drilling since the last oil price crash. You can see the pie chart on the right that the proportion of spending on infrastructure-led is more over 50% compared to high impact drilling. But the ILX prospect inventory is finite. It does have materiality constraints for bigger companies who are tending to sell out of their late life assets in mature basins. And I think this represents the primary opportunity for small and mid-sized E&Ps for production-led, infrastructure-led exploration going into the future. Turning to gas, where does gas fit in? We saw that, or I mentioned earlier, that explorers still are favouring oil over gas, and you can see the chart on the left shows the well count for high impact wells and the split between wells targeting primarily targeting oil versus those targeting gas. And you see the vast majority have been targeting oil. So in 2020, 71% of wells targeted oil, and that was higher than the 2011 to 2019 average. And that trend we see continuing into 2021, where 83% will be targeting oil as the primary target. So despite gas being touted as the sort of transition fuel, because when it substitutes for coal and power, it does bring emissions down, explorers are not targeting it over oil. They're not increasing the proportion of wells targeting gas, and part of that is the overhang of stranded gas that we found in the last 10 years in remote areas that is waiting to be developed, still seeking a market. And also you can see, in terms of comparing the wells on the left with the resource discovered on the right, that we've been finding a lot of gas in the last few years and continuing into 2020. So explorers are still favouring oil, and the focus for gas is now is finding big prospects with access to attractive gas markets that can be commercialised quickly. But finding those big prospects close to markets that can be commercialized quickly, they are rare. They're difficult to find, and hence they don't make up a large part of the drilling inventory. And now I'm going to turn to look at where we might be exploring in the next few years. We don't have visibility to 2026 in our databases. We've got visibility through to about 2023, and this map shows circles proportional to the number of wells that were visible, planned to be drilled in by basin globally. And you can see the focus in Latin America and offshore Mexico over the next few years. A smattering of wells, high impact wells in Africa, a few still in the North Sea, but the Far East still having relatively few high impact wells. We don't have that very good visibility into China or Russia, so hence there aren't many wells shown there. But this gives you a flavour of where the industry will be targeting its high impact wells over the next through to 2023 that's visible right now. And if we look at those wells and split them up by region, we've identified 170 wells. The colours there, red is frontier, green is emerging plays. The yellowy colour is the maturing plays, and blue is mature plays. We're talking here about high impact wells, so wells targeting 100 million barrels or more. Hence, there are fewer high impact wells in mature plays. You can see the focus is very much Latin America and what we call it the LACAS, but that's Latin and Central America, we've included Mexico in that group, and that's where dominantly where the activity will be. Africa is still dominated by frontier drilling, as there are relatively few emerging plays in Africa right now. On the if we look at it in volume terms, it's a similar picture to the well count. We've got 63 billion barrels of unrisked high impact potential potentially being tested over the next 3 years, which risks down to about 12 billion barrels risked, and 80% of that is oil in the risked drill out. But given past performance by the industry, that percentage of oil will probably go down. In reality, that we're still finding a lot more gas than we're prognosing pre-drill. I'm going to turn finally now to the company landscape and look at how that might develop going into the future. And I've split the company landscape into the super majors in green in the charts, the large cap companies in red, dark blue is medium size, grey is small, and the NOCs are the light blue at the top. And what I've highlighted is what I call the squeezed middle. So the middle and medium and small size companies are playing a diminishing role in exploration, high impact exploration, both in terms of equity and in terms of operatorship on the right hand chart. This is not because the NOCs and super majors have been increasing their spending. It's more that the small to medium sized companies have been cutting their spending more than the larger companies, and that trend is likely to continue. So if we break that down a bit and look at go through those different categories and look at what companies have said about exploration in the context of the energy transition. Let's start with the super majors, start with BP. Their emissions targets is net zero scope 1, 2 and 3 by 2050, together with a radical reshaping of their business model. They have said they're going to cut production by 2030. This excludes Rosneft, but the non-Rosneft production is going to be cut by 40% by the end of the decade. And exploration spending is going to be slashed to 350 to 400 million a year, with no new country entries. So that means BP is really effectively withdrawn from global new ventures. Shell has a net zero scope 1, 2 and 3 target by 2050 also, and it has signaled that oil production is going to decline by 1 to 2% per annum. Gas will grow to 55% of production. Exploration is going to be focused in 8 core countries, and it will have no new country entries after 2025. So if we're looking at exploration 2026, Shell will be out of the market for global new ventures for new country entries. Total, they are net zero scope 1 and 2 and net zero for scope 3 in Europe only by 2050. So not quite as radical as BP and Shell with regard to targets. Oil production is planned to be steady, and they plan to grow gas. So oil and gas production overall is to grow. Exploration, they have signaled that they will be spending $1 billion a year, split 50% in emerging basins, 35% mature basins, and 15% in frontier. Exxon have said they support the Paris goals. But they're much less radical, much less ambitious in terms of the targets they've set, and their targets are very much short-term rather than long-term. So they've said scope 1 and 2. They've set scope 1 and 2 intensity targets to 2025, and they're going to hold production steady, but they haven't said much about exploration. Chevron, similar to Exxon, have said they align with Paris, whatever align means. It's not entirely clear. And they've signaled upstream emissions intensity reductions for 2028. And in terms of production, they're going to grow from 3.1 to 3.5 million BOE per day in 2025. And again, they haven't said much about exploration, but in terms of high impact exploration, they have been doing a lot less than the other 4 in recent years. So if you take the super majors as a whole, one can say that by 2026, they're going to be playing assuming Exxon and Chevron is business as usual, you would expect the super majors as a whole to be playing a smaller role in global exploration. What about the majors and large independents? Well, there's a similar European-US split in terms of strategy. Eni and Repsol are very much aligned behind the BP Shell Total approach. The US majors less so, more aligned with the Chevron Exxon approach. Of course, this may evolve under the Biden presidency. We'll have to see how that plays out. But at the moment, we've got this Atlantic split. Eni have probably gone further in articulating their strategy than most other companies. They've articulated it as to, quote, monetize discoveries quickly, exploration focus on near field and proven basins, and selected initiatives on frontier basins. And by 2050, it expects 90% of its production to be gas. And you can see the chart on the right from the strategy presentation earlier this year, the 44% of wells in near field, 44% in proven basins, and 12% in frontier, with quite a big emphasis on gas, with a 2 billion barrel target over 5 years. What about the mid caps and juniors, the squeezed middle? I just highlighted a couple of companies as an example. Cosmos is an interesting one because they were created as a dedicated frontier explorer by private equity in the 2000s. They are arguably the most successful frontier explorer during that time, opening 2 plays, the Tano Basin play and also the Mauritania Senegal gas play. And they were, I think this was very significant because they were the first to break ranks in 4Q 2019 to say that actually, and you see the slide below, no new basin opening oil exploration past the current portfolio. And for the poster child of successful frontier explorer to make that change was quite significant. And they're going to, they've pivoted to focus on short cycle infrastructure-led exploration with a focus on the Gulf of Mexico and Equatorial Guinea. And since this announcement, have sold their some of their frontier acreage to Shell. Cosmos would want to say, the Cosmos explorers would want me to say that they haven't given up on risk. I think they would like to see themselves as contrarian infrastructure-led explorers. They still got an appetite for risk, but they're going to apply it in near-field exploration where cycle times are short. Cairn, another very active mid-cap that was very active in frontier exploration, opened a new oil play onshore India in Rajasthan, where it made its fortune, and then reinvested the profits from that endeavor in frontier exploration. Quite a bit in an unsuccessful campaign in Greenland, and then they had frontier success in 2014 in Senegal, and they subsequently appraised that field, Sangoma, and brought it to development. But significantly in 2020, they sold out at below cost to reinvest that money in buying gas-weighted, low-cost production in Egypt with infrastructure-led exploration upside, which they saw as being a more sustainable option. So this is what I was referring to as the opportunities for the mid-caps and juniors in production-led, infrastructure-led exploration. It looks like it's a trend that will continue. What about the NOCs? Will they fill the gap left by some of the larger IOCs leaving the international space? Well, Equinor, CNOOC, and Petronas have been the most active international NOCs, and they were recently joined by Qatar Petroleum. Equinor is likely to follow the path of the European majors in terms of strategy, so it's not obvious to see that Equinor will fill the gap left by BP and Shell, for example, and some NOCs are also beginning to embrace emissions targets that go along with the resilient exploration. Of course, a lot of the NOCs, international NOCs, partner with the European IOCs and are familiar with the targets and the strategies of these companies. It's conceivable that some Middle Eastern NOCs may follow QP's lead into international exploration, but it's not certain, but it's conceivable. And the Russian NOC strategy is unclear, but it must be tempting geopolitically for some countries to use the reduction in competitive intensity to increase their influence through global exploration, but it's by no means guaranteed. So, having gone through that, what can we conclude? Firstly, looking at the projections for demand, it seems that there will be demand for production from discoveries made in 2026, given the forecasts of a significant supply shortfall, even under an energy transition on track for 2 degrees of warming. But any discoveries that we make need to be resilient to the long-term likely low oil price of $40 a barrel. So we need to have full cycle break-evens of less than the $40 a barrel. We need to have attractive returns at $40 a barrel. We need discoveries on production within 5 years, payback within 10 years, and be producible with net zero carbon emissions. All of these factors are going to impact on NPV and restrict NPV if you take all these I should say that the $40 is going to have a big impact on constraining NPV. So if you look at the EMV side of the equation, the resilient exploration is also going to need a high commercial success rate in order to make the to maintain positive EMV. So as well as these criteria, we need to maintain high success rates. The third conclusion, as far as we can see, as far as what's visible, exploration hotspots in 2026 are likely to be similar to the present, but with lower well counts, and as our emerging plays mature, probably lower discovery sizes also, barring significant basin opening discoveries. And that's your argument for continued frontier exploration to renew the emerging play portfolio and help us deliver discoveries that are that meet the resilient exploration criteria. And finally, competition is likely to diminish as incumbents exit or restrict exploration. That is unless we get new well-funded exploration companies are created by financial markets, which, given the ESG investor movement, doesn't seem likely unless private equity moves in to fill the gap, which again doesn't look necessarily likely, or more domestic NOCs expand into international exploration.
Thanks very much, Keith, for the excellent presentation. So thanks very much, everyone, for your questions. Please leave more questions in the Q&A box. I can see lots of more coming in right now, and I'll hand over to Graham, who will be facilitating the Q&A sessions. But before we start with the Q&A session, Graham, are we ready to share the poll? So here is the poll that Keith mentioned earlier. So please submit your vote for question 1. 99 high impact wells were completed in 2019. How many high impact wells will be completed in 2026? And for question 2, how many new 5 billion barrel or greater oil plays will be open between 2021 and 2026?
Great, thanks, Silly. Thanks, Keith. Of course, great talk. Thank you very much. So I think we've got about a minute to answer the poll. So please kind of click your buttons, and we'll have a look what you think about the future. It'd be great to hear what you think. In the meantime, we'll kick off with the Q&A. There's a bunch of questions come in. We'll start off with one about stranded gas. As you mentioned, there's a lot of stranded gas around the world, which doesn't seem to be going anywhere. Is there an opportunity to commercialize some of the gas by converting it into electricity kind of in location rather than exporting the physical gas by potentially LNG? Any thoughts on what to do with all the stranded gas, Keith?
Well, I don't know. I'm not sure there's a huge demand for electricity in northern Mozambique or southern Tanzania. I'm not sure that really particularly helps you by converting the gas into electricity in those remote areas. I mean, they're stranded partly because they're remote from any gas demand. And I'm not sure converting to electricity where we're talking about the big volumes of stranded gas is that going to help you?
Yeah, sorry, it's just David here, just adding to that as a point. Typically, your domestic demand is extremely small, whether it's on power or for gas itself. So what you really want to do in most of these areas is ensure that your gas goes somewhere else. And LNG, one of the reasons, as Keith was saying, it's stranded is just because it needs to find a home, and it often needs a big demand center to go to. So it will struggle.
Okay, that's good. Great. Thank you, Keith. Thank you, David. Another question on the squeeze middle. As the squeeze middle companies, the mid caps and the juniors get less of the exploration pie. Who's going to pick up the slack? I think we mentioned the possibility of a price hike in the medium term. Surely, if the price goes up, someone will step into that gap and take advantage of the opportunity to make a quick buck, perhaps. What are your thoughts on that, and who might take that opportunity?
Well, it is going to depend on what individual company strategies. If the majors are committed to the net zero targets, that it's not obvious that they would step back into to exploration. It's not obvious that that would be consistent with their strategy. So therefore, then you're looking at NOCs. You're looking at whether more domestic NOCs would be tempted, or whether private equity will look to fund exploration because they'll see the rewards there, or whether we'll see a wave of companies startup exploration companies listing. But again, there is a lot of the ESG movement is very strong in the investment community. So, I mean, those would be the alternatives. I think. I mean, David might have a view on that as well.
Yeah, good point. No, you're absolutely right. They're also going to be using things such as emissions. How many absolute and emissions intensity are they really getting out of what they're doing at the end of the day? And one of the big motivators, as you can see, for selling off assets at the end of the day at the moment is to reduce your overall emissions and your emissions intensity, rather than just because it's a good time to sell as well, right? So there are different motivations going on in their strategies relative to maybe somebody else.
But there is a lot of capital swishing about in the world, and there will be if the price signals are there, if the oil price it looks like in another super cycle, there will be capital that will flow into exploration from somewhere, because not all a lot of capital is following ESG principles, but not by all means not all of it, and some of it will flow back into exploration, presumably through startup ventures or through private equity backed ventures.
Okay. Yeah. Thanks, David. Gareth, are we ready for the answers to the poll?
Yeah, give me 1 second, and they should be on your screen now.
Yeah, I see it. Thank you.
Thank you. So that's great to see. Thank you very much, everyone. A great response. Thank you for voting. Looks like in terms of high impact exploration activity, there's a significant majority suggest that numbers will be going down. We saw that obviously 2020 was something of a strange year, and we had just about 79 wells completed in 2020. Things seem to have picked up again. I think we're back to business as usual at the moment, as we see companies potentially fulfilling commitments and completing programs that were deferred through 2020 into 2021. But in the longer term, I think the view is that we can expect things going back down to less than 2020 numbers, less than 79 going forward, which I think is probably not unexpected. In terms of the optimism for finding a new significant multi-billion barrel oil plays, well, again, there are some optimists there. We saw from the creaming curve slide that there's only Suriname, Guyana, which has come in more than around about 2.5 billion barrels since 2006. But there are 109 people who think that we are going to find another 5 billion barrel or greater oil play. Let's watch this space and see where it's going to be. I think so. Thank you so much for that. That's really good to know. I think it's clearly a question on everyone's minds, and we're asked this frequently, and something I think we'll bear in mind going forward with future conversations with you all. So back to the Q&A. A question about LNG, and might we see a rise in smaller scale FLNG projects if just are suitable, again, as a way to potentially commercialize some of the stranded gas? Any thoughts about the role of LNG going forward? Keith?
I was going to defer to David on that one.
Okay, David.
So I think we're specifically talking about floating, right? So floating LNG. So I haven't looked at sort of floating LNG specifically in a couple of years now, but my recollection from a lot of that is, there are places where that kind of technology may have played a role, but the minute you've got large areas like Australia and the US bringing on swaves of very low cost LNG in relative terms, there just isn't a market, right? There isn't a big enough market for something like that. So FLNG may have a role to play, but I think it's just been beaten out the water by many other options, and that's why gas remains stranded and will be more likely to be driven by politics than commercial reality, I guess, than anything else. So I wouldn't necessarily put FLNG as the savior for these things right now.
Okay, thanks, David. A question on are the commitments by the super majors in regards to kind of emissions only about their operated areas, or could we see some of these companies going in for new country entries, vast exploration programs, and significant carbon emissions hidden in non-operated activity, perhaps going in below the radar screen?
Definitely. David, you want to take that one again?
David.
Oh, okay. Yeah, I mean, it's an interesting one because you start to need to unpick really, I guess, what each of these companies are doing and how they're doing it. And classic criticism of some of the targets of the set is that they include some things and don't include others. Now, I don't want to pick out any particular companies, but there is, of course, a point where if it's operated versus equity, and you need to be really careful as to what are each of the companies saying that they're going to do, and what does that ultimately mean. So, for example, there's one of the companies that says, we are only going to focus on equity, which is great because you have control over that in one way, but others are just on operated. So if you suddenly don't have only have control over how you're operating it, but you might have a stake in it, as an example, that's fine. But if you own a stake in it but don't know how to operate it, then I'm not interested in that. That's actually quite dangerous because you're not really sort of committing to the principle of what net zero is about. But yeah, you're absolutely right. It can be hidden in that way. And at the moment, I think a lot of investors are taking quite a close eye and saying, okay, what are you actually truly committing to here? And taking a close eye on divestments, on investments, and those types of things. So you need to unpick the very clear detail of each of the strategies to understand what's going on to see whether it's actually working what it says on the tin in that sense.
Okay. Thank you, David. So another question, do you think that companies are going to kind of stick with these grand aspirational strategies going forward when declining production really starts to hit their cash flow? As may happen. Keith again.
Well, not with the same CEOs in charge. I don't think that it would have to be a change. It would have to be a change. It would have to be a change of leadership. You can't get away from that. They have made the biggest bets. I mean, they've committed themselves and their reputations to it. So you'd have to have a change of leadership.
I think it's also worth just recognizing that these companies have put a lot of statements out there, but also quite, I would argue, sensible in the way they're doing things, right? This is not an on and off switch. Now, obviously, some companies are putting out more extreme examples of what they're saying, but again, if you unpick it, it's actually probably slower, as you would say, than maybe the extremity of the situation says it would be. And typically what you're seeing is some portfolios are continuing to grow actually in the short term. Investment in transition. So we had a webinar yesterday where we looked at transition CapEx. Yes, that's tripling, but from an extremely low base, and it's still only about 16% of the folks who are saying they're going to be net zero in Europe, for example. So this is, yes, it's happening and it's moving and it's changing, but it's maybe not at the pace that people think it is. Of course, it takes over the narrative because it's about a change in direction of the business as a whole. But I think there is a real focus also on making sure that the cash flow is there for a longer period of time to help make that transition. It doesn't happen overnight. And I think that's important for a lot of people to recognize.
Yeah, I mean, I think I would change develop that question a little bit more to say that what the test is going to be, because we're seeing a divergence in strategy, in a way that we haven't seen within the major companies in recent years. So what will be interesting to work is to, as things play out over the next 5-10 years, is how those strategies translate into financial performance, and how that financial performance translates into shareholder returns. Because ultimately, that's how the leaders of these companies will be judged, at least by the financial markets, is how they, the different strategies, how have they performed and how have they delivered for their shareholders. And that'll be interesting to watch. And I think the jury's out as to whether BP's strategy is the right one, or whether Exxon's is the right one.
Great, thank you.
We'll all have a view. Find out who's correct in 10 years.
Keith, a question related to, I think, about the metrics used for exploration decision making and investment, which I know is something you've been thinking about. A question about how important the governance part of the ESG agenda will be, and perhaps also expanding on that, what do you think will be the kind of metrics that exploration companies use for making investment decisions on opportunities going forward, and how might they change from what we have today?
Well, so when you say the governance, are you talking about governance internal to an oil company, or governance of the sector from government?
Well, the ESG, I guess, it probably a bit of both. I think probably there will be some internal standards set by the boards, but there will also be standards being set by the environments in which companies operate.
I think there's two elements there. I think one is interesting is how government will react, and we've seen that some developed economy governments reacting by ceasing issuing of exploration licenses. But up to this point, it's been countries with where you could say fairly modest exploration potential. I think what would be interesting is how will developing countries react with regard to the challenge of attracting or there's reducing exploration capital. So how do we attract exploration capital to our countries, where you say, well, we don't have many resources. We think we've got some oil and gas. Maybe we need to, rather than playing hardball with the companies, maybe we need to relax our terms to, get it discovered and produced as quickly as we can, because we don't have many resources. So I think, and you might even see some of the resources that are currently stranded, relinquished by some companies and taken up by others on different terms, maybe more attractive terms. And perhaps it might even be acquired by companies that don't have the same ESG constraints as the publicly listed companies. So the G is both, works on the government side and also internally. In terms of the metrics, you think of the conventional EMV equation. A lot of what we're talking about is challenging to the NPV side of the EMV equation. So I think the commercial aspects of the commercial sense of success are going to get more and more important. So we'll be looking much more, prospects have much more scrutiny with regard to those resilient exploration criteria than they might have done hitherto. Success rates are obviously going to be crucially important, because if you've got pressures on your NPV side of your EMV equation, you need to make sure that your risk side of the EMV equation is minimized. So improving success rates is going to be key. So commercial chance of success is going to be continue to be a key metric. alongside the resilient exploration metrics, if you like.
Okay, yeah, that's great, thanks. Okay, I think we've got time for one more question, which is an interesting one, I think, to finish on. So how do you see the human resource market in exploration going forward over the next 5, 10, 15 years? I guess a question about capability, the great crew change, things we've been talking about for a little while now.
Well, I mean, if you take the logic of the argument, and you know, and there seems to be the consensus of those on the call also, that we're going to see fewer wells drilled, probably by fewer companies, then the logic would tell you that we're going to have fewer, it's going to be a smaller business. Going to be fewer explorers, and but we are. I think, but there is going to be turnover. It's an aging industry still. But I think overall, I think you have to. I mean, Graham, you should probably be answering this question, because in your previous slide, it's more down your your specialism. But I think it's got to be, you've got to see a slowly shrinking market. But I think geoscientists are going to have to be more, broaden their commercial skill set. So it's not just about the subsurface. We need to be thinking about all these other aspects, these full cycle aspects, to not just will we find something, but can we commercialize it? Yeah. All the factors that are going to influencing whether to commercialize.
Okay, that's great.
Add something to that?
Yeah, thank you, Keith.
No.
I think we're at time now. That's 3 o'clock. Thank you all for your attendance. Thanks for your response to the poll. Gareth, Illy, anything to say to close?
Yes, just one more thing on events. Thank you, Gareth. I saw you posted the link to the State of Exploration webinar that's coming up on the 12th of May. So the State of Exploration, as all of our clients know, is really looking back over the past 5 years together with exploration drilling plans for 2022. So please click on the link and register to attend the State of Exploration webinar, which is based on our annual flagship report. Gareth?
Thanks, Lily. Just one more thing to add. I think we had a flurry of questions in at the end there. If we didn't get to your question, and Gabriel, I think that was one also, we will follow up with you afterwards, one-to-one. So don't worry if we didn't get to you. We will get in touch after the session. Yes, so I think that's it. Kept nicely to time. Thank you very much, Keith. Great presentation. Thank you to everyone on the Q&A, and thanks to everyone for coming along again. The session will likely be available video on demand for clients. So just watch your email and we'll be in touch again soon. Thanks, everybody.
Thank you all.
All right.
Cheers. Bye-bye.
Bye.
Thanks.